This final chapter, Chapter 5, contains 4 quiz questions to test your understanding of these materials. Question 1. You are conducting a credit analysis for a retailer. Using the information on the next slide, calculate the debt to EBITDA and RCF to net debt ratios, as these would be adjusted by Moody's, and adhering as closely as you can to the definitions and conventions we used in this module. Here are the key financial metrics. Which of the following is true? Here are the 4 permissible answers. Solution to question 1. The worksheet you see here, labeled Question 1 Solution, begins by reproducing the key metrics you were given in rows 5 to 14. Immediately underneath, beginning on row 17, we have calculated the various ratios and other metrics needed to answer this question. Cell F17, for example, calculates EBIT as the sum of net earnings after tax plus interest expense plus taxes paid, exactly as you would expect. Importantly, cell F20 adjusts the interest expense from cell F7 by adding to it 1/3 of rental expense under operating leases, exactly as explained in chapters 2 and 4, pursuant to the Moody's methodology. And similarly, cell F21 adjusts depreciation and amortization by adding to cell F6 2/3 of rental expense under operating leases. The remaining cells immediately underneath continue in the same manner and are not discussed individually. But note especially in cell F26 the addition of 8 times operating rentals to the balance sheet debt from cell F9. In cell F31, the subtraction of dividends from cash from operating activities to obtain RCF before adjustment. In cell 32, the adjustment of RCF through the addition of 2/3 of operating rentals. And finally, in cell F34, the use of net debt rather than gross debt via the subtraction of cash and cash equivalents. We observe in adjusted terms a debt to EBITDA ratio of 3.42 in cell F28, and then in cell F37 an RCF to net debt ratio of 24.36%. Therefore, the correct answer is B, as in boy. Question 2. Retailer X raises $2 billion in debt at 6% and uses the proceeds in their entirety to purchase equipment from a competitor. The equipment has a 20-year useful life and will be depreciated using the straight line method. The financials of Retailer X immediately before the issuance of the new debt and the purchase of the equipment appear on the next slide. Here are those financials. Which of the following ratios will change the most when comparing the financials immediately before and immediately after the debt issuance and the purchase of the equipment. Here are the 4 permissible answers. Solution to question 2. Once again, we have reproduced in rows 5 to 14 of this worksheet labeled Question 2 Solution the data provided in the question. Immediately underneath, starting on row 16, we have calculated the relevant ratios for the company immediately prior to the purchase. Specifically, a debt to EBITDA ratio of 1.78 in cell F22, a ratio of 39.29% for RCF to net debt in cell F28, and a ratio of EBITDA to interest of 2.82 in cell F34. Continuing down the worksheet, we have calculated these same ratios for the company immediately after the purchase and the incurrence of the debt. Specifically, a debt to EBITDA ratio of 3.27 in cell F44, a ratio of 34.38% in cell F50 for RCF over net debt, and finally a ratio of EBITDA to interest of 0.02 times only in this cell F56. The EBITDA to interest ratio is visibly the one that has changed the most. Therefore, the correct answer is C, as in Charlie. Question 3. Based on your memory of what you learned in Chapter 3, which of the following is the correct classification of risk factors for auto manufacturers, airlines, restaurants, and retailers according to Standard & Poor's? Here are the 4 permissible answers. Solution to question 3. Regarding product cycle / obsolescence, the grid provided from S&P that we showed in Chapter 3 looks as follows. You may recall that in Chapter 3 we noted in particular S&P's view that product obsolescence is a high risk factor for retailers, but commented that for giants like Walmart it is hard to understand what product obsolescence might mean in aggregate, and furthermore that for retailers that specialize in food, clothing, or pharmaceuticals, any one item or family of items may well become obsolescent, but demand in aggregate for this category of goods seems reasonably assured. Still, the fact is, S&P views product obsolescence to be a high risk factor for retailers. Turning to marketing costs, the grid provided from S&P that we showed in Chapter 3 looks as follows. Here we commented that the risk of marketing costs, ranked in the medium category, as you just saw, by S&P, falls somewhere between its corresponding ranking for autos and for airlines. Adding that we did not doubt that car sales need more marketing than shirts, but that it was not obvious to us that Oreo's cookies are marketed with any lesser zeal than round-trip tickets to Rome. Thus, the correct answer is A, as in apple. Final question, question 4. Assume, entirely hypothetically, that a modestly leveraged retailer whose cash from operations is positive has earned a BAA in each of the 9 subfactors under the Moody's rating methodology. Confirm first that its overall rating is Baa2. The retailer has no operating leases, and interest rates are currently extremely low, so that interest expenses annually are negligible for a borrower of this size. If the government of the country in which this borrower is located decided to pay off 100% of this retailer's debt with cash and to ask for nothing in return, the retailer's credit rating, assuming only the criteria in the Moody's grid apply, would most likely increase to. Here are the 4 possible answers. The worksheet you see now, question 4 solution, a copy of the one you saw at the end of chapter 4, shows the BAA grade earned by the retailer for each subfactor, as well as the Baa2 rating it achieves overall given the individual inputs in column G and their weights in column C. The elimination of all debt for the company would have no impact on the qualitative factors and no significant impact on revenues, since interest expenses are negligible, as the question stipulates. Also, the 3 financial subfactors, namely debt to EBITDA, EBITDA to interest expenses, and RCF to net debt, would all rise into the AAA category as a simple mathematical reality. Changing the Baa ratings for these 3 subfactors to AAA in the worksheet reduces the weighted average score from 9 to 5, as you can see in cell L16, increasing the overall credit rating to A1, appearing in L18. Unfortunately, we are not quite done. The elimination of the company's debt via the government's donation would leave the left-hand side of the balance sheet unchanged, while replacing debt with equity on the right-hand side. In principle, this could have an adverse effect on the 9th subfactor, namely EBIT to average book capitalization, pulling the rating down from A1. To see how material this could be, we now replace the Baa rating for this subfactor in cell G12 with BA, finding the weighted average score rises to 515, then with single B, then with CAA, and finally with CA, and observe that the overall score rises ever so slowly, peaking at this 5.55 in the very extreme and implausible scenario in which the rating for this subfactor, we remind you, were to become CA. Otherwise, the overall score remained below 5.5, which you can confirm in your own time leaves the rating at A1. Therefore, the answer is A as in apple. This completes the quiz, part 2, and this entire module on retail industry analysis.